Hey everyone, welcome back to Corporate Decoder, the place where we sift through mind-numbing corporate filings so you don't have to. Today we're diving into the semi-annual report for ALPS Series Trust. It sounds like a snooze fest, but trust me, hidden inside are clues about where your money really is. Ready to decode? Let's find out if these funds are making smart moves or just moving your money around. But before we get started, if you want even deeper insights, make sure you are subscribed to the channel and come join our community over on Discord. There is a link in the description below. Alright, let's set the stage. This isn't just one company, it's a whole collection or a trust. We're talking about ALPS Series Trust. This trust manages a bunch of different funds and each fund has its own investment strategy. To inside, we have Beacon Planned Return Strategy Fund, Brigade High Income Fund and Carrot Kansas Tax Exempt Bond Fund. It is for the reporting period of October 1, 2024, March 31, 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 2024, March 31 Investment Strategy Fund, Brigade High Income Fund and Carrot Kansas Tax Exempt Bond Fund. It is for the reporting period of October 1, 2024, March 31, 2025. Let's get going. First up, the Beacon Planned Return Strategy Fund. The key here is understanding its approach. This fund aims for a planned return, which means they're trying to manage both the upside and the downside risks in the market. So what does it cost to play this game? A $10,000 investment in the Beacon Fund would run you about $62 in expenses for 6 months. This translates to an expense ratio of 1.23%. That's how much of your investment goes towards running the fund. What are you actually getting for it though? The Beacon Fund returned only 0.70% for the last 6 months. To put that in perspective, they mention the CBO S&P 500 Buy Right Index, which delivered a 9.80% return during the same time. To put it simply, your money barely moved in the Beacon Fund compared to a different strategy, which gained almost 10%. Why such a difference? The directional component, which is the bets on the market going up, made money thanks to the S&P 500. The income component, selling options to make cash, actually lost money, and the hedge component also lost money because the S&P 500 went up. So the protection against losses cost them. Now let's zoom out and see how it performed over and crimed. So the protection against losses cost them. Now let's zoom out and see how it performed over a longer time. Since its beginning in 2017, it looks like a $1 million investment in the Beacon Fund would now be worth about 1,699,634 index would have grown to approximately 2,500 index would have grown to approximately 2,500 index would have grown to approximately $2.58. And on average annually 7.34% versus S&P 500 13.12%. The fund has total net assets of roughly $328 million and 82 portfolio holdings. The fund turnover rate is 0, which means they pretty much held on to everything and didn't change their holdings. Now, how is this money spread around? Short-term securities make up about 1% of the portfolio, a whopping 106.91% in purchased options and negative 7.95% in cash equivalents and other net assets. What purchased options are more than 100%? What is going on here? Let's peek into the top 10 holdings to see what they're doing. Almost all of them are options. The strategy here is to buy call options on the S&P 500 index for different months and different strike prices. The largest one of these positions goes to call XSPR Gut $72 options, which expire in August 2025 with a strike price of $72.00. Options, which expire in August 2025 with a strike price of $72.00. Options, which expire in August 2025 with a strike price of $72.00. With a strike price of $72.00, each went MOS. Hot price of positions goes to call XSPRGU. The reporting period has no material fund changes as well as no changes in disagreements with the accounting firm. Let's check the Brigade High Income Fund, aiming for current income with a side of capital appreciation. This one's cheaper. A $10,000 investment costs just $26 in expenses for 6 months and has an expense ratio of 0 we're getting in return for our dollar. Since the fund's creation in May 2023, a $25 million investment in the founders class would now be worth about $30,953,037 of Bloomberg US Aggregate Bond Index. Basically, a generic portfolio of bonds would be worth about 26,762 Shin 468. Not bad beating that index. The founders beat the Bloomberg US Aggregate Bond Index. Basically, a generic portfolio of bonds would be worth about 26,762,468. Dozen Forfani Botti Dollars Aggregate Bond Index. Basically, a generic portfolio of bonds would be worth about 26,762,468 $408. Looking at the annual average numbers, the founders class had 9.117% for the last year and 11.78% since inception. That is compared to the Bloomberg US Aggregate Bond Index, which is 4.88% and 3.62%. This fund is sitting on about $663 million in total assets with 3 of 1 holdings. The portfolio turnover rate is 18%, meaning the managers made relatively few changes. So what are they buying? Corporate bonds take up 58.2%, bank loans 36.9%, then smaller positions in common stocks and cash. Looking at what sectors they are in, there is a large percentage in consumer cyclical and non-cyclical. This would basically describe companies that sell services and goods to consumers. Let's pick at the top 10 holdings. The first position goes to Tenet Healthcare Corp, which accounts for 1.1%, and the total of all the top 10 positions is just 9.2%. This fund is a lot more diverse than the Beacon Fund. How risky are these bonds? About 2% is BBB, 28.6% are B, and 12.1% are CCC, with the rest being not rated. This is basically a portfolio of junk bonds, meaning they are riskier but have higher yield than investment grade bonds. No material changes or disagreements with the accounting firm were reported. The Carrot Kansas tax-exempt bond fund, so it's specifically for people who want to avoid paying taxes in Kansas. This fund is cheap, just $18 for 6 months on a $10,000 investment or 0.36%. So is it making any money? For the last 6 months, this fund actually returned negative 0.85%. The manager said performance was driven by the increase in municipal bond interest rates. Ouch. Compared to the Bloomberg Municipal Bond Index, the measuring stick, the fund had a rough run. Since 2015, $10,000 in the Carrot Fund would be about $11,141 today, while the Bloomberg Index would be $12,341. Over the last 10 years, the average annual rate to the fund was 1.06% versus 2.3% from Bloomberg Municipal Bond Index. So it has been way underperforming. The fund has about $120 million in assets with 167 holdings. So where's the money? The fund is invested in 5, 10 and 10 plus year range and pretty much nothing else. This makes it more prone to interest rate hikes. As the sector weightings, the fund is 59% in general obligation unteed and 35% in revenue bonds. Looking at their top holdings, they seem to mostly have bonds for the state of Kansas and for local counties. And again, we have the same story where there have been no material changes, as well as no disagreements with the accounting firm. And finishing our report here, it's the Clarkston Founders Fund with its Founders Class ticker CFMDX. The expense ratios for this fund based on 10,000 is about $40. Now, the big question is, how did it perform in the last year? Turns out it hasn't done very well. It returned 147% versus the return on the Russell Midcap and Russell 3000 indexes of 2,000 indexes of 2,000 indexes of 2,000 indexes of 2.81% respectively. The top 3 performers for the period include LPL Financial Holdings Inc., a brokerage and investment advisory firm, GFL Environmental Inc., a waste management company, and Warner Brothers Discovery Inc., the media company. The 3 biggest detractors for the period were Clarivate PLS, an information services provider, Avantor Inc., a manufacturing company, and Lamb Weston Holdings Inc., a provider of potato products. How did they do since inception? Turns out a hypothetical 10,000 investment in the Clarkston Founders Fund would be $11,151 compared to the $14,251 compared in the Russell 3000. This fund has also not performed as well as its target benchmark index in terms of value growth. This fund has total net assets of $778,822,536, with the biggest allocations going to consumer, staples, financials, and industrials. They're going for the boring stocks that are the most reliable and don't fluctuate as much. Lastly, we again see a lack of material fund changes, as well as accountant disagreements. We have the Hillman Value Fund, which has also had some bad results, and they are trading as CMX. It also had some changes in the total numbers for the last year. The rest of the reports are very boilerplate and not very interesting. That said, some things stood out in this report. IFT, there is a general trend of underperformance. Funds are performing poorly when compared to their target index. While management fees were aligned, some of the underlying stock picks of these funds seem risky, which could have made them more susceptible to general market declines. Ultimately, there's not enough that is positive in the funds to justify investing in them for most people. Tap 2. Okay, that's all for now. Let me know what you think. As always, make sure to hit the like and subscribe buttons for more content, and join our Discord channel in the description below for behind the scenes and more community discussions. See you on the next one.